A new Sky Data poll has found that more than two-thirds of young adults are worried about paying off their debts if interest rates go up. The findings come as an increasing number of people are forced to use credit cards to make essential purchases. Sky's business correspondent Adam Parsons has this report.
It's never been cheaper to borrow money, and we're doing a lot of it. Between us, we owe £200 billion on credit cards, personal loans and overdrafts, a level we haven't seen since the financial crisis. Our unsecured borrowing went up by more than 9% last year, and this money isn't just going on luxuries. The debt charity Step Change says 8.8 million people in the UK have had to use credit this year to pay for life's essentials: food, heating, clothing. There's not much doubt that consumer spending has been good for the UK economy in recent years, and a lot of that spending has been built on easy credit. But as interest rates look like they're going to go up, then the cost of borrowing will also increase, and a lot of people are now worrying about that. And research for Sky News suggests there's one group that's worrying more than any other, and that's young people. Sky Data asked a sample of adults if they were worried about coping when interest rates rise. 65% of young people said they were, a much higher proportion than other age groups. We also asked if people would support a government-imposed limit on credit card spending and found nearly two-thirds in favour. And that goes up even higher among young people, where 7 in 10 back the idea.
If you want to travel, go on holiday, for instance.
So are those people who were just about managing now beginning to feel the squeeze? Dwayne Grizzle from Watford has a job, 2 sons, a mortgage, and he may have a headache on the way. It's been years since interest rates last went up. Are you ready for the day when they go up this time round?
I don't think I am. I think it's something that I've heard about the news, I've read it in the newspapers, I've seen in financial papers and everything else that it's been increasing. But because it's not really had the impacts quite as yet on my finances, it's something I'll have to look at in the short term and in the long term. But in terms of how do I prepare for it? If my earnings are still going to be the same when it increases, then there's not really a lot that I can actually do. The Bank of England worries that not enough checks are being done on the people who borrow this money. It says another financial crisis could see the banks facing losses of £30 billion. Right now, the Bank of England insists there's no debt bubble, but there are plenty who see growing debt problems and start to worry. Lending has changed since the last crisis, not least on the road. Car finance is now the fastest growing sector of the market, worth some £58 billion. So has it grown too fast?
Car finance, as the Bank of England has confirmed, amounts to just 1.2% of household income. So it's, in that sense, although it's a significant area of consumer lending, you have to get it in proportion.
Credit is not a bad thing in itself, but the problem comes when you can't pay back the money. And when interest rates go up, that problem will become more pressing. Adam Parsons, Sky News, Watford.
Sharon Jaswal is Director of Education at MyBnk, which helps young people manage money, and she joins us now from central London. Very good afternoon to you. First off, why are so many youngsters finding themselves in so much debt?
Well, what we find is we've got a younger generation who have really high social aspirations. They want a lot out of life. However, they are constantly told that their future is bleak. There is the uncertainty of Brexit. They are never going to be able to afford their own houses. And they're essentially a lot poorer than their older generations. Younger people are paying 3 times as much as their grandparents did on housing costs. And basically, they, in real terms, they are a lot poorer. And these days, credit is just a few clicks away. People want to go on holiday, people want small luxuries, and for vulnerable young people in particular, they face the trends of 0-hour contracts and delays and long waits on benefit payments, so their income is quite insecure and they are tempted to reach out for credit. And these days credit is easier to get than it was previously.
Obviously, things like short-term loans and loan sharks are pretty dangerous because you can end up in spiralling debts. Is there a safe way to borrow money, would you say?
I think the safest way to borrow money is to be educated before you make that decision. We work with young people every day at MyBnk, and we find that they haven't got the knowledge or the confidence to navigate the financial maze out there. They're not making informed decisions on their futures. They are getting tempted by teaser rates and these sort of low monthly payments, and not thinking about what the overall cost of borrowing will be. And with credit being a little bit easier to get, often you find people who only just qualify are being given these credit cards and other credits. And what you find is that young people, if those payments rise or their income falls, they won't be in a position to make those payments. And it's generally only mortgages that have affordability checks, but actually for other credit as well, affordability and ability to pay in the future should be taken into consideration.
But of course not all credit is bad, is it?
No, it isn't at all. And I think intrinsically there's a lot to be got out of credit cards. I mean, it's important for young people to build up good credit, especially when they risk not doing so with phone contracts early on. And there's a lot of perks. You get payment protection on credit cards. You can move your money around on 0% deals. However, you have to know what you're doing. So that's why being informed at the point of purchase, reading the terms and conditions, understanding what the impact will be on your life is really, really important.
And I suppose for lots of young people, the temptation is, if you're at university or something like that, then you max out credit cards. If they come to you, what is the advice that you give them to manage their finances in an efficient way?
I think it really is just knowing what you're getting into and asking your friends, asking your family, going to experts, making a budget and knowing what your monthly outgoings are, knowing what you can afford, and understanding that if rates do change, can you afford to still make it? There's some research out there that says that half of under 35-year-olds couldn't handle a £250 bill if it was put on them unexpectedly. And I think in terms of students especially, they have access to thousands of pounds of interest-free overdraft, but now they also have access to credit cards, and they're tempted, they're hearing that it's going to be hard for me to get a mortgage, so I need to take out credit. And student credit cards in particular, they might have lower limits, but their interest rates are usually higher. So if you get into that that trap of minimum payment, it's always easy to forgo a full credit card bill and instead just buy a holiday instead. But then you get you fall at risk of falling into that minimum payment trap. So it's really about knowing what you're getting into before you do make that decision.
Indeed. Thanks ever so much for your expertise. Appreciate your time.
Thank you.